As we march towards the opening bells, we've been talking about the latest figures on the U.S. economy, the jobs numbers encouraging investors, and we mentioned that Earl Davis telling us that he's fairly constructive on the outlook for the U.S. economy. Let's get some investing ideas from Earl, who's head of fixed income and money markets at BMO Global Asset Management. First of all, I mean, for those who are watching the stock market, I think even though the S&P's had a nice rally off the lows, people are still trying to determine their risk tolerance this year. Overall, what would you say how has that impacted activity in the bond market?
Yeah, activity in the bond market has been very similar to activity in equities, which is a good thing right now. So when we had Liberation Day, bond spreads widened. So that meant you got a higher yield than you would have a month earlier. So that's a good thing. So in the bond market, the big difference between bonds and equities, you always have to look out for probability of default because you want to get your money back from that bond. But with that, you also look at how much coupon you're getting, and does that offset that probability of default from a risk-reward perspective.
And so if an investor is looking at something other than sort of a good old-fashioned government bond, and I think this is what you're getting at, higher yield, the balancing act is, you know, what's a good business that would be associated with that higher yield? What have you seen when you've sort of looked through the field there? Yeah,
just before I go into that, the other thing that's very important is a diversified portfolio. You need to have a lot of bonds in your portfolio to reduce the risk. So the bond that we like, but we have a very diversified portfolio, so I promise that. It's a high yield bond. It's called Top Aces. It's basically the Top Gun of Canada. They do fighter jet simulator training and live training for all the allies across the world. Wow. Why we like this, it gives you a yield above 9%, 9.20. And the reason why it gives you such a high yield is it's its first issuance in Canada, only 200 million. The name is not that well known, and it's a niche industry.
Well, you made me think of like CAE, which maybe their arrival or something like that.
But CAE is flight simulation, not fighter flight simulation. Yeah. So it's basically your Top Gun.
Okay.
And that's why they have a very nice pocket that we believe is recession-proof. And the reason why we believe it's recession-proof is because you're seeing defense spending going up across the world. And that will remain whether the economy is doing well or we're in a recession. So we like the yield, we like it in a diversified portfolio, and it's one of our Top Aces, one of our top recommendations.
Well, and it's funny, like when, you know, if we were to talk about diversification in a stock portfolio and someone were to single out like a stock pick, I think we'd sort of understand it. But you singled out a corporate bond pick, but also talked about diversification in your bond portfolio. So what's a good way to do that? If you need to have a good level of diversification in fixed income, how do you go about doing that?
Yeah, so there's two ways to do it. It's the quality of the credit profile. So for example, an offset or the opposite side of the spectrum to high yield is government bonds. We also like 10-year Canada government bonds because which has a much lower yield. So the 10-year Canada government bond has a yield of approximately 310, 315, almost 600 basis points below this for longer term, but that's because it's safer. The reason why we like this in the portfolio as well is because, you know, Canada's economy going forward is less certain. So there may be more Bank of Canada eases, which should benefit Canadian bond holdings. So that's a good offset. The other way to offset and diversify in a portfolio is having a number of corporate bonds, different names, different industries. In our bond portfolios, we have hundreds of names. That's why that's good. From an individual perspective, I would say if you're going to invest in individual names, you should have at least 20 names. That means not more than 5% of your investment in any one bond, and ideally it should be lower, closer to 2 to 3, but a minimum of 20 bonds you should own in a bond portfolio if you're an individual investor.
Which sounds like a lot. Maybe that's one of the reasons why people like funds and ETFs and that kind of stuff these days.
And that's one of the reasons I'm employed exactly. as an active manager.
So just we were showing what's happening with the 10-year bond in Canada. I think the jury is still out on what happens with interest rates. But what you're saying is your gut tells you that interest rates today are not the level of interest rates we'll see, call it by the end of, like there's a good chance we'll see rates continue to come down in Canada. As for how much, who knows? but that creates an opportunity to lock in something like a Canadian 10-year at this level versus where it could be, I don't know, in the future. Is that?
Yeah, and so yes, and we like Canada as part of a diversified portfolio because in the U.S. we actually see rates going higher. And there's different dynamic in U.S. The economy is going to be doing better, so less chances that the Fed eases. And they have a lot of supply. They have a very large deficit that they got to issue more and more bonds. And ultimately, your price of bonds depends upon supply and demand.
When do you see rates going higher in the U.S.? I foresee a bit of tension in the headlines out of the White House if that were to happen.
So that's a good point. So when I say rates going higher, not overnight rates. So I don't see the Fed hiking.
I see.
But 10-year bond yields. Maybe I should do it. Yeah, 10-year bond yields because of the supply of 10 years that has to come out. Thank you for allowing me to clarify that.
Well, thank you for clarifying that as well. But actually, to your point, like everybody had been watching that 10-year yield recently, and the bond market had been sort of signaling its uncertainty, hence that lower yield, which you're saying if things get back to normal to a certain degree in the U.S., that lifts the yield.
Yeah, and to complicate things even more, it doesn't mean you.
Why not?
It doesn't mean you shy away from buying 10-year bonds. And the reason why you don't shy away, if you're going to hold it to maturity, you will still get paid par. You buy it at par or 100 cents on the dollar, you get paid 100, and you earn a nice coupon above inflation in the meantime. So that's a thing to remember, you know, like the return over time is your yield. And as long as your yield is above inflation, you're going to be better off.
Okay. Earl, great to see you. Thanks for the learning lesson as always. Earl Davis of BMO Global Asset Management. We're getting closer to the opening bells, but